delivering the benchmark returns or Nifty returns, but outperforming it. So be an alpha investor. Alpha simply means this, earning over and above the Nifty returns and doing that consistently. Also, we want to make sure that while we're doing that, we don't want to lose our sleep. So without a substantial increase in risk, in fact, reduction in risk, we're trying to earn an alpha over the Nifty returns. Now, compound investing or compounding is not really an intuitive thing for most of us. So it's always good to see it for ourselves in front of our eyes. So just let me show you something. What we have in front of us is um, a simple example. Had we invested 10 lakh rupees at 12% rate of return for a period of 30 years, that same 10 lakh grows to 3 crore rupees. It's pretty phenomenal, right? 10 lakh grows 30 times to almost 3 crores in 30 years at 12%. And today, what we're going to be talking about, or what we're going to be trying to do, is deliver somewhere in the range of 20% returns. So let's see how this makes a difference, the difference between 12% and 20%. Boom. 3 crores versus 23 crores. 30x versus 230x. That's the big difference that we're going to be seeing today. And we have with us Kislay Upadhyay. Now, Kislay is a veteran in the industry. He has been working with the who's who of the investment industry. He's worked with Saurabh Mukherjee. He was a part of the core team who wrote the national bestseller Coffee Can Investing. After that, he worked with Sunil Singhania, another veteran of the industry, very well respected name. He's also currently working with the NSE on machine learning. And he's an MBA from IIM Lucknow. Without further ado, I'm going to hand over the mic to Kislay Upadhyay. A very, very warm Kislay. Welcome, Kislay, and we hope that you entertain us with all the knowledge and insights that you have to share for us.
Thank you, Jay. Thank you for having me here and those kind words of introduction. Thank you, everyone, for joining us on this morning of 23rd of July. Google tells us that 23rd of July is celebrated as Peanut Butter and Chocolate Day. I don't personally know anybody who has celebrated this, but that's what Google tells us. About 2.5 decades ago, on this day, on this very day, 23rd of July, a group of scientists led by Ryuzo Yanagi-Machi from the University of Hawaii announced that they have somehow cracked cloning on mammals. Fortunately or unfortunately, it did not take off. Today, we don't find applications of that scientific development in our life today. On this 23rd of July, though, that's today, we are going to talk about some scientific developments which do find pervasive application in our day-to-day life. So if we type machine learning on Google, it throws us about 2 trillion search results. Today, we are at this interesting cusp in human history when the hype created around something is not too far off from the amount of impact that it has actually created in our lives. The applications of machine learning, knowingly or unknowingly, is something that we see every day around us. Be it from manufacturing to entertainment to healthcare and even art. Machine learning has penetrated every field of our lives, and investment has not been left too far off either. In fact, it won't be a too bold a statement to make that machine learning is the most powerful tool for investment analysis the world has ever seen. Combining the change that all other investment tools have created in the past maybe 50, 100 years, machine learning more created more impact, combining all of those tools, more than even computers, which came about 25, 30 years ago. So let's look at how much machine learning and use of rule-based frameworks has penetrated trading and investment. If we look at trading, be it developed nations or in India, the level of penetration has been matured and deep. Today, if we talk about any trading firm, you would seldom find any of those without having a machine learning cell within them. We come to investing, however, developed nations have adopted machine learning to a large extent. Machine learning has penetrated deeply. More than 70% of investing is done through ML and AI in America. More than 6 of the top 10 global hedge funds publicly claim that they are driven by data. The rest 4 don't publicly claim it. In India, however, this is in a very nascent stage. As is the phenomenon with most of fintech and investec trends, India lags the West by 5-6 years and Hong Kong by about 2 to 3 years. We have seen heavy adoption of rule-based investment in the West and across other developed nations. Thus, it is safe to conclude that there lies a huge opportunity to outperforming in fundamental investing in India using ML. Now, personally, my journey towards rule-based investing started when we started the coffee can PMS in my previous role. It was based on a very simple strategy, a very simple filter, and it created phenomenal returns. From there on, the journey started towards building a comprehensive system that can create such investment rule, analyze and backtest it, self-improves it by themselves, and we are able to prune it into investable products, practical investable products for real life use. That led the foundation of Fidelfolio's 3 pillars. The system that I'm talking about is shouldered by the 3 pillars of Fidelfolio, 2 of which are machine learning engines. First being Fidelfolio Strategy Generator, which simply creates investment strategies. Investment strategies are simple filters or screeners to identify stocks for investment. The second ML engine, Fidelfolio Strategy Analyzer, analyzes and backtests the strategies created by the strategy generator. They operate in a feedback loop in a self-learning manner. The third pillar, human training and oversight, is responsible for training these ML engines. These 2 ML engines in particular have been trained with over 100 million data points of the financial statements, the P&L, balance sheet and cash flow, share price, etc., of more than 5,000 NSE listed companies for the past 32 years, roughly since 1991. The human role overarches validation, sanity check, and the qualitative analysis, along with training these 2 ML engines. This is the principle on which, this is the foundation on which Fidelfolio's investment system is built on. To put it very simply, the strategy generator creates millions of investment strategies. The analyzer computes statistics like returns, standard deviation, probability of returns, drawdowns, etc., and recommends the best strategy. The human element validates and selects the strategies that are practically usable for investment. This gives the final investment portfolio. Now, the first investment product that we churned out of our system is the compounder strategy. This is probably the compounder we have heard. All of those who are familiar with the investment world would have heard the name compounder many a times. This is one of the oldest investment strategies and the most effective in creating tremendous wealth if invested in and invested in a disciplined manner for long term. What are compounder strategies? What are these companies that we call as compounders? This strategy, firstly, is simply investing in companies that are able to grow their free cash flows and earnings consistently over years and decades, and are able to reinvest those cash flows back into their back into their business at the same high returns of capital, return on equity or return on capital employed, so that it becomes a self-growing machine in itself. Such compounder strategies grow their profits tremendously over long terms of 5-10 years, much higher than the broader market. And consequently, the driver of the share price, the tremendous share price performance of these compounder strategies, is the underlying profit growth of the companies. We talk about, let's say, the reason or the secret why these are the features that differentiate these such companies from the others. We'll have to talk about the ability to generate free cash flow consistently. Secondly, these companies are mostly market leaders with significant market moats. They always stay ahead of their peers. Strong corporate governance and ethics is a must have feature of compounder strategies in any company wherein we want to invest for longer term. Strict adherence to capital allocation framework is something that is very core to these to such companies. They won't waste your money in unprofitable business segments. They have professional management, institutionalized systems and processes, where succession planning is built in the internal architecture itself. The consistency of driving returns itself is built into system. Innovation is also built into the system. So nothing is happening on the whims and fancies of a Lala, like that of a Lala company. Lastly, and probably one of the most important factors, one of the important features of such compounder strategies is that they are usually very capital light. They have low leverage on their balance sheet, and they do not require a lot of debt or a lot of cash flows to grow their business going ahead. Now, to identify these compounder strategies, now that we know that what these compounder strategies are, what these companies are, what the features of these companies are, identifying these companies from a pool of thousands, 5,000, 10,000, 5,000, 6,000 companies listed in the stock exchange is not something we can do manually. Our systems, our machines have identified certain strategies and rules to find such companies. We have filtered out four of the most usable, the best investments compounder strategies out of the hundreds of thousands of strategies that our machines have created. Let me explain strategy one here. It's a very simple set of rules which selects companies that have delivered 20% return on equity and 8% operating profit growth in at least 11 of the last 13 years. So the three key components here are high capital efficiency, consistent business growth, and doing it every year for the past long term over a decade. Strategy 2, 3, and 4 are other such strategies which have identified great companies to invest in long term. We roughly look at the statistics that these rules have created in the past 20-30 years. We see that the returns, all of these strategies have delivered returns in excess of 20%, well above the benchmark return of 12%. However, the downward standard deviation, the metric we use to assess the risk, is almost similar to Nifty in 2 of the cases and higher than Nifty in the other 2 cases. However, the third and probably very important metric, the risk per unit of return per unit of risk, a form of this ratio is also known as Sharpe ratio. This is not exactly the Sharpe ratio. This is return per unit of downward standard deviation. We see that in all the strategies, where the risk is slightly higher than the index, the return per unit of risk is much higher, and in certain cases it is twice as much. Consequently, this gives rise to a significant healthy alpha of 8 to 12%. Now, the key factor about this alpha is the term consistency. The alpha has been created keeping in mind multiple investment points in the past 20-30 years in the Indian markets. So had we invested any time in the past, let's say I randomly choose 1st of July 2010, even then there is almost there's a very high probability that such alpha would be delivered in the next 10 years. Let us look at so our system has analyzed uh, uh, how has visually tried to help us understand how these rules have performed better than Nifty 50 in the past. This plot over there is return versus risk. On the x-axis, we can see the average return. On the y-axis, we can see the risk, which is captured by downward standard deviation. The higher these dots, the higher these dots on this graph, the more risky it is, the more towards the right it is, the more return generating it is. So the uh, bottom right corner is the best quadrant with highest return and the lowest risk, and the top left is the worst quadrant with lowest return and the highest risk. The dots, the different colored dots in the chart that you can see represent the different investment periods. The blue being for 1 year investment, the bluish black being for 1 year investment horizon, and the yellow being for 10-year investment horizon. Quite distinctly, if I ask you to make an analysis out of this graph, I think more than 90% of us would be able to see that there are two distinct sections on this graph. The one in the circle is the contains the dots that correspond to the Nifty 50. We see that all these dots have an average return of 12 to 14%, and return ranging from this point here, which is close to 8%, to close to 27%. The other half of the graph, as we can see, are these compounded strategies 1, 2, 3, and 4. What is interesting to see is all these strategies, all these dots are not higher than the Nifty, significantly higher than the Nifty, but they are significantly towards the right in this graph, which means that they are generating very high returns without corresponding commensurate higher risk. The biggest advantage, if I ask you to spot the biggest advantage from this graph, quite easily we can see that the yellow dots is where the true alpha benefit lies. Yellow and the orange ones, the longer investment horizons, is where the risk is lower or exactly same as that of Nifty, but the returns is maybe 10 percentage points higher. This is what we saw in the previous table as well, and this is what we are seeing in the graph too. Now let us see what our machine has to tell us. What is the emotional journey one had undergone had one invested at any point of time in the past in any one of these strategies. For demonstration, we have taken the strategy 1, the strategy which we had described before. Before that, let us look at certain probabilities that our system has calculated. So the first graph gives us the probability of giving negative returns. The second graph gives us the probability of giving positive returns. The first is less than minus 15%. The third graph is probability of giving more than the risk-free rate of 7%, roughly 7%. And the last one gives us a probability of generating more than 25% returns. The orange line in all the 4 graphs corresponds to the Nifty. Quite starkly, we can see that in the past 20-30 years in India, these 4 strategies have been better in all the 4 aspects compared to the orange line, which is the Nifty. The probability of generating less than minus 15% is much lower than the orange line. The probability of generating positive returns, or generating more than 7% returns, or generating more than 25% returns, all of them are significantly higher than that of Nifty. Now let's talk about the emotional journey that one would have undergone had they invested at different points in time in any of these investment filters. So we are taking a look at strategy 1 as a demo. This line shows the value of rupees 100,000, 1 lakh rupees invested on various dates, starting from 2001. So starting from 2001, the green represents the green shade represents the positive positive investment returns that we had made. So starting from 2001, had we held it till let's say 2011 for 10 years, the returns had been would be roughly where the mouse is pointing. Similarly, for 2002, 3, 4, 5, 6, 7, 8. If we look at, I would like you to pay attention to charts 2007 and 8. This is a very relevant question that plagues our mind consistently. How well these strategies, how would the strategy perform if there happened to be a market crash or a correction today? Now, this is what happens in times of market correction. This one is starting 2007 and this one is starting 2008. For a period of 1.5 years, the portfolio gave 0 negative returns. Similarly, for a period of about 6 to 8, 10 months, the portfolio gave negative returns had we invested at the bottom of at the middle of 2008 subprime crisis. What follows is what is interesting to watch. What follows is tremendous wealth generation. Irrespective, people started 2 years before the crash, people started during the crash, or people started after the crash. We can see similar results for subsequent years also. This is portfolio starting in 2016, 17, 18. We see that a lull period of reds happened for 2.5 years. This was a period marked with 2020, wherein the portfolio dropped by close to 20-25%, and it came back up to deliver very good returns in the overall period. The same was seen for the portfolio investment starting on 2019 and 2020. The portfolio starting 2019 also had a lull period, and then it took off. If we put this 20 graphs, the 20 graphs represents 20 years of the past, into tables, and compare the returns, the CAGR returns for 10-year investment holding with the Nifty CAGR, we see handsome, consistent outperformance compared to the Nifty. These rows correspond to the investment start dates of July 2001, 2002 up to 2010, and from 2011 to 2020. We see in all of these cases, starting at any point, holding it for 10 years, the returns has been in the range of 20-25%. Average returns have been 20-25%, while that of Nifty has been 12 to 14%. Alpha consequently has been in the range of 8 to 10%. The same happens even for lower investment horizon. We can see from the start of July 2013, it hasn't been 10 years since this portfolio has started. This portfolio have only 9, 8, 7, 6, 5, and 3, 2 years of run. We see that the volatility of alpha has increased. There is also a 36% alpha, and there is a 0% alpha also. But the average remains close to 10%, which is, if we remember from the previous graph, this very much goes well with what we saw in the previous graph. The consistency of returns increases significantly for longer investment horizons compared to the shorter ones. The shorter ones can see periods of 36% of outperformance and low outperformance as well. But in the longer run, what we have seen in the past is a consistent outperformance of 8 to 10%. Now that we have understood, we have spoken about, we have discussed the compounder strategies in numbers, how these strategies have fared. Hopefully, most of us are convinced that this strategy has generated significant value in the past. The question comes, how do we use it? We have identified 3 traits of holy grail of investing based on the compounder strategy. It's very simple, 3 traits of holy grail, which is invest for long term in compounder stocks in a systematic manner. Let me take you through each of these. Why long term, and specifically why long term for compounder companies? This also answers a very important question. What is so special about these compounder strategies that they have generated such returns? Why? What is the driver of their great price performance? And the reason lies in this table, and particularly on this middle column. The EPS or profit CAGR is what differentiates these companies from the broader market. From 2012 to 2022, uh, a couple of these companies which we have taken for illustration purpose only, these companies have been identified by our strategy as consistent compounding companies. These companies have generated a CAGR, a profit CAGR of 25% and 35% respectively. While the Nifty, the broader Nifty, has grown its profit by a meager 10% only in these 10 years. And mind you, this is not just an opportunity, a coincidental 10-year period where such a thing has happened. This is a usual phenomenon across time. If we pick any time in any starting and ending point, most of the times we would see great profit performance of such companies compared to the broader market Nifty. Consequently, the significant price CAGR difference, while these two have delivered 30% and 53% price performance, the Nifty 50 has delivered 12%. What do we take away from this table over here? And also this graph where we see that the yellow line is profits, the profits of these companies and Nifty rebased to 100, and the red one is the price performance. First, most important takeaway is that the earnings growth is the key driver for long-term equity performance. If there is one metric anyone can ask you to track in a company for a long-term investment, that is how well these companies are growing their profits and free cash flows. That is all that you need to look at. Since these companies deliver superior earnings trajectory, and that is why these companies deliver superior price performance compared to the market too. This slide tells us how the power of compounding plays in favor of such companies. There could be companies that have grown at a CAGR of 20-30% between over the last 10 years, but there could be several zeros and negative profits in the intermediary years. Such companies do not amass as much of wealth, as much of free cash flows as these compounding companies do. Thus, holding investments for long terms is practically feasible in such companies only. Consequently, timing becomes irrelevant, and also permanent capital erosion is very unlikely in such companies. The third pillar, the third trait of the holy grail that we spoke about is systematic investment. This is a very interesting chart. We have all heard across mutual fund advertisements, and all investment experts across that we should invest in a systematic manner. And I cannot emphasize that point more. No expert, nobody who is aware of, who is familiar with the financial markets would advise you against this. Now let us see in graphs and numbers how what is the importance of systematic investment. The graph on this left shows us the CAGR return had we invested in Nifty 50 at a very unfortunate timing, that is a market peak of 2012, or a very fortunate time of market bottom of 2012. In the next 6 years, even after 6 years, the difference in the returns, CAGR returns of these two strategies is these two investment points is huge. While the unfortunate timing gave us 5% CAGR, the fortunate timing gave us 16% CAGR. No doubt these lines are converging. That is, over a longer term, if we continue holding it for 7, 8, 9, 10 years, these 2 points would further converge. But the time it takes for it to converge is longer if we are unfortunate in timing the markets. And as I firmly believe but we can't time the markets. We cannot rely on timing the markets and choosing the blue line. So what is the better way to reach closer to the long-term average returns and not impacting our investment portfolio so much because of the element of timing? Systematic investment. The right side of the graph on the right side of this slide shows us what the IRR would have been had we invested in 8 installments in these in Nifty 50, again starting from the same unfortunate time of market peak and market bottom. And the stark difference is within 2 years, the IRR of these two starting points converge. No doubt the convergence would happen even in this sort of investing also, but it takes a lot longer and might not completely converge. But had we invested in a systematic manner, the emotional turmoil that we have to go through for the initial 4-5 periods would have been reduced to almost zero. That is the power of systematic investment. This is true for all types of investment, including the ones in compounded strategies. So if one wants to achieve the long-term average of 20-25% of 20-25% returns of compounded strategy very quickly within 1 year, I would recommend one to go with systematic investment. These are the portfolio details. We have close to 21 stocks in our portfolio currently. It's a concentrated low churn strategy. We are market cap agnostic. We have a little bit bias towards large cap, but we have companies across all market cap segments. In terms of sector, also we are well diversified. Right from so these companies are touching our lives in almost every way, in every manner, every day. Most of us. The portfolio performance has been we assess our portfolio's performance primarily by the growth of the profits and the free cash flows. We know that the share price performance is an outcome of the same. So we have showcased Q4 22 growth of our portfolio. We can see that the average growth has been Q-on-Q growth has been 12 to 14%. The YOY growth has been close to 30%, and 2-year CAGR has been 65%. Of course, we should not expect such numbers to continue going ahead. These are extraordinarily high numbers. Partial reason is low base of the previous year, and also a significant market share gains during over the last 1.5 years during the turmoil of these companies has resulted in extraordinarily high profit figures. Going ahead, we expect the profit figures to be close to 25-30% YOY. Now, looking at this second table, we can see that the average returns, the average growth, simple average or weighted average, is not due to few lopsided companies generating 100 and 200% returns. We see that all these more than 90% of these companies have generated brilliant returns. The ones be it Q-on-Q, be it YOY or 2-year CAGR. And that is the power of this investment scheme, investment technique. This strategy ensures that almost all the companies, more than 70, 80, 90% of these companies deliver great profit growth, and consequently more than 70, 80, 90% of these companies generate great price performance. In terms of portfolio performance, we have closed for the past 6 months. We have closely tracked the benchmark. Who should be investing in our portfolio? Anybody who has a long-term framework, believes in fundamental investment, believes in the power of machines, has patience, and can exercise discipline and ignore the noise around. This is a very important Fidelfolio investor pledge. I urge all of you to quickly go through. This mostly tells us to invest with patience and discipline, not to panic with short-term market returns, not to get swayed with short-term greed, have a longer-term horizon, and have the realistic expectation and understanding that generating 20% plus returns over long terms is tremendous wealth generation. There is no point seeking 50 and 100% YOY growth for extraordinary high risk that it undertakes. There's a disclaimer. Please exercise your own judgment and risk assessment and risk profiling before making investment.
Thank you so much, Kislay. I hope everyone has had good knowledge from this insightful presentation that Kislay had made for all of us. Just to summarize what he has been talking about, this strategy of Fidelfolio Investments tends to deliver somewhere around in the range of 20% over a longer period of time, obviously up and down based on the market situations, but tends to try and deliver around that percent mark with a relatively lower risk. It's not coming with a substantially increased risk. In fact, the risk to return ratio is pretty good in this strategy, and it helps us deliver much better than the Nifty returns over a longer period of time. He gave a disclaimer at the end that this is meant for those people who can stay patient over a longer period of time. For those people who are lured by greed or by better returns in bitcoins and trading, they generally tend to lose out. So disciplined investing, and through this strategy, it will be very easy. So how do we make sure that we are able to take the benefit of the strategy that Fidelfolio is offering? There's a simple platform. Many of you would have heard of Smallcases. So we have tied up, Finvisor has tied up with Fidelfolio to bring the strategy to all the investors. We'll be providing a link to you, wherein through that link you'll be able to invest. However, for Smallcase, there is a select set of brokers in which you need to have accounts. I'll quickly be showing those brokers. Right. If you can see, these are the names of the brokers with which Smallcase has tied up. So we will need to have account with either Angel One, Dun, Grow, HDFC Securities, ICICI, Zero, the Upstocks. There are 10-15 brokers with which we may need to have an account. If you already have an account, we'll be providing you a link through which you can easily invest. Secondly, right now, we're not giving that link because a fixed fee folio is active, and an AUM based fee portfolio, which is going to be more suitable to most people and it is cheaper, that will be available soon. So we'll be providing that to you. Divya, if you can share the link of your WhatsApp, everyone who's interested in this portfolio can just go through the link in the chat and send a hi. We will be getting in touch with you and helping you proceed with this portfolio investment. At the same time, we'll be helping you understand the overall portfolio composition. And if you have any further questions, I think it's a good time right now. Anyone having questions can ask them. You can post them either in the Q&A or in the chat box. Hi, Pranay. Lovely, lovely. You can all post hi on the chat box also, or through the link. Most welcome, Rajesh Bhai. Yes, Devansh, we'll be getting in touch with you. Are there any questions that anyone has to ask relating to the strategy? Anything that was unclear that you would like to re-go through again?
Hello.
Yes.
Yeah. Hi, Anmol. Hi, Jay. Anmol here.
Hi, Anmol.
Yeah. So my question to you and Mr. Kislay, right?
Yes.
So that the strategy says you are seeing the profit growth and cash flow growth, right? These two factor are the main you are analyzing. Of last how many years?
Kislay, would you
Hi,
like?
Anmol. Yeah, thank you for the question. Thank you for asking that question. Let me explain that again. I'll just take you through the slide again. So the question you asked, Anmol, has two aspects to it.
Yeah.
First, what does the filter use to identify such companies? The filter for the first strategies had identified two metric, which is return on equity for last return on equity of 20% and operating growth of 8% in 11 of the last 13 years. So let's say over the last 13 years, starting from 2009, uh,
Yeah.
a company has delivered more than 8% profit growth and 20% return on equity. 12 out of the 13 years, then we'll select those companies. It is not CAGR, it is every year or counting the number of years it has delivered such a return. If a company has delivered 8% operating profit growth only 10 times and 13 out of 13 times it has delivered 20% return on equity, it still does not get accepted in our portfolio, or it does not get through the initial filter of our portfolio. The second aspect of the question is what these companies deliver. This is a way to identify these companies, but what are the characteristic features of these companies? These companies continue generating profit growth and free cash flow growth for years and decades on end. Most of the companies in our portfolio have delivered at least 2 decades of very robust and consistent growth. Their free cash flows has grown more than 15, 16 times of last 20 years by more than 15, 18%. They have almost never shown a negative growth. So these are the features of these companies. Hope I answered your
So,
question.
thanks for the your answer. But in continuation with that, so if a company has delivered in last 13 years, 11 in out of 13 years, 11 years of this number, profit growth 8%, and then operating profit growth and ROE is 20%. So what gives you that confidence that it will continue to deliver that kind of growth and profit, right? Because we are investing for, let's say, next 5-10 years. So that is not clear still to me.
Let me explain this through an example uh, of using a filter approach for any other application in life. Let's say you have to hire 15 candidates for a company that you have founded. Now your HR comes up with a simple filter that hire people, hire the people who have uh, who got more than 80% marks in maths and 80% marks in science for all the years starting from 5th till 12th, and the same and similar results in graduation and post graduation as well. Now the history, you have seen the history of such people, that people who have shown such consistency over the last 10-15 years, more than 90% of such people continue delivering such consistency in the future. So out of these 15 candidates that you hire, maybe 12 candidates would continue to be gems who would drive your company in a very good manner. The 3 candidates might not turn out the same way,
Yes.
but those 12 would be sufficient to drive your company ahead. This is by example I'm saying what is what I've told you. Let me tell you the how we ensure conviction in such companies using our own filter and human approach. Our filter has shown that such companies over the past 20-30 years have generated extremely robust returns. So history of this filter, not the history of these companies, history of these filter So the investment in this in 2001 in this strategy would be in companies that had qualified in back in 2001. The investment in 2006 would be investment in companies that had
Understood.
qualified, right? So
So the
this
companies
history,
which have qualified in 2001, that given for next 10 years, 15 years, alpha kind of return as compared to Nifty. So
correct, correct. So that is one, the history of the filter has been very robust, just like the history of the filter that your HR used was great. The second is the qualitative analysis that we do. We understand the deep-rooted modes around these companies. Our fundamental research ensures that these companies continue to maintain those modes, continue making the right capital allocation decisions, and continue maintaining the robust internal architecture, which ensures systematic innovation and outperformance.
So thank you for this. But I think one last from my side. Ki, after all this filter, if you find anything like going wrong with the company, whether it's with the management or with the sector or with the company itself or whatever, so how fast you are in churning that company or portfolio? Are you
The
taking that
natural,
risk or you
yeah,
will be waiting for something, or what you will look at that time? So because
the
nowadays
natural,
world is changing very fast, and then fast action is sometime also required, if I'm not wrong.
absolutely, Anmol. This is exactly what we agree with. And in line with this only is the third pillar of our system, the human training and oversight feature, which does the qualitative analysis and ensures that the reasons that these companies have shown great outperformance, the reasons continue to stay intact. The management continues making right decisions. This is an ongoing and everyday, every second process. And the moment we find that the fundamentals of these companies have changed, we churn out these companies from our portfolios, and vice versa. The moment we find that the fundamentals of a company merit a company to enter our portfolio, we do the same. Otherwise, on a natural rebalance, semi-annual and annual filter is annual period is where the filter does that rebalance.
Okay, I think thank you from my side. Thanks a lot.
Hi,
for your-
Dhruv, you wanted to ask a question. You can go ahead.
Yeah, thanks, Jay. Thanks, Kislay, for the presentation. It was wonderful. I think there was some network issue. I might have missed one of the points, so I just wanted to rediscuss that. In one of the slides where you had mentioned a rough composition, so it showed 30 companies, and there was some below that there were some rows where financials were there. So what is the difference between the two? Yeah, sorry, the previous one previous slide.
Okay, yeah.
Yeah. So on the right side, the table just shows a portfolio, right? The companies which are part of your strategy portfolio. So there are 13 companies, and below that it's written 7 financials. So what is the difference between the two?
Yeah. Sorry, I could have written it in a different manner. The companies represent the X financials, and these are 13 X financial companies. These 8 financial companies are from the BFSI sector, including banking, financial, insurance, and life sciences.
Understood. So sector, financial services you meant.
Yes.
Okay.
Thank you, Dhruv. Pranay, you had a question, I believe, that would have been answered in Anmol's question. Am I right? Or do you have a further question, Pranay?
Jay, Dhruv here. Just in the meantime, I had one more question.
Yes.
Yeah. So, Kislay, after the minimum investment of 4.5 lakhs, if say we want to invest by way of a SIP methodology monthly, is there going to be a possibility on Smallcase to do a SIP in your portfolio? And what would be the amount, minimum amount?
Yes. So there is a methodology. Just like any SIP, we can go with monthly, quarterly, or semi-annual SIP. The amount is close to 90,000. The details of the same can be seen on the Smallcase website itself. So we can make 90,000 SIP in 6 months, 3 months, per month, or yearly, as it chooses.
Understood.
All right. Cool. Do we have any further questions? Anyone who willing to ask questions can raise their hands. Yes, Reena, you wanted to ask a question.
Just one question. So Smallcase is like a broker, and then the way we select the portfolios in the mutual fund, is this something related to that? Or like I'm not aware about what is Smallcase. A small brief, if you can give me on that.
Sure, sure. So Smallcase is basically a platform which makes investing in a set of stocks very easy for the lay investor. So through a Smallcase, portfolio managers like Kislay create these portfolios of stocks which are regularly monitored, which can easily be changed. And as an investor, as a lay investor, you can simply, with the tap of one button, invest in all of these stocks. So Smallcase is just that platform which makes it easy for you to do this.
Okay, okay. And Fidelfolio is one of the
Fund managers.
fund manager, part of Smallcase.
Yes, they're listed on Smallcase.
Okay, okay. Got it. Thanks.
Most welcome, Reena. So I hope everyone has who's interested in the portfolio or wants to know anything further has sent a hi on the WhatsApp or on the chat over here. We'll be bringing this webinar to an end. Thank you very, very much, all of you, for your time, and hope you have taken something back which will help you improve